Let's look at the difference between product costs, period costs, and other expenses. Now we know what other expenses are from previous lessons, but we don't know what product costs and period costs are. So what we're going to do is we're going to take the expenses incurred in running a trading firm, and that's one that buys and sells inventory. What we already learned is that any cost to get the inventory from the supplier to our business to get inventory in a condition and location ready for sale is called a cost of goods sold. And it's going to be things like cost of sales, delivery in, packaging, buying expenses, customs duty, could be other things, but that's some of them. And then we said there's other expenses, and then you can think of it as getting the inventory from the business to the customer. In other words, expenses incurred in running the business on a daily basis and or getting inventory from the business to the customer. So we already know that. So what we're going to do with this topic is just break down this cost of goods sold category a little bit. So what we're going to do is we're going to say there's actually kind of two categories within the cost of goods sold. So the expenses incurred to get inventory in a condition and location ready for sale, what we're going to say is the ones that we can allocate to individual units of inventory on a logical basis, we're going to call those product costs. And then the costs incurred to get inventory in a condition and location ready for sale that we can't allocate to individual units of inventory on a logical basis, we're going to call those period costs. And this can get very, very confusing. We'll still have other expenses, so they'll stay the same. So the expenses incurred in running a trading firm are either cost of goods sold now actually has two categories. We've got product costs and period costs. And let's look at the definitions here. They're actually identical at this point. A product cost, all costs incurred in getting inventory in a condition and location ready for sale. And a period cost says the exact same thing. So that's how they're similar. How are they different? Well, the product costs are the ones we can allocate to individual units on a logical basis, and the period costs are the ones that we can't allocate to individual units on a logical basis. What does logical basis mean? Well, we'll look at that when we do some examples later. Most importantly, from now on, when someone says what's the cost of the inventory, we don't say it's the purchase price. It could be, but it's actually all these things here that go into the product cost. So from now on, we're going to say, what is the cost of inventory? It is the product cost. We'll still have other expenses, they haven't changed. So the best way to look at this is to take an example. So on January 1st, a furniture retailer bought 10 units of these couches here, and we're going to sell them for $500. And these are the following costs. So the first cost was the supplier's price for 10 units. It was $180 per unit, and the document was invoice 345. But couches are big. It's very hard to get a truck big enough to go and pick them up. So maybe we had to pay another business for delivery inwards. The supplier delivered them to us, and they charged us $200 to bring those 10 couches. And it looks like we paid cash because there's a check there. Whereas up here, this was an invoice. It looks like we paid credit there. We also had, let's say these couches came from overseas. We incurred some customs duty to import them. However, we pay that annually, it looks like, not for each couch. We just pay a one-time annual fee, again with cash. Then we market the couches. We got them in, we take out an ad on Facebook or whatever for $300 saying, come buy these couches. And again, it looks like we paid with cash. That's BPay. And lastly, a customer who buys a couch needs it delivered to their house, and maybe that costs our business money. So the delivery cost to each customer is going to be a total of $500 for 10 units. So it'll be $50 each, and it looks like we paid with cash. So what we need to do now is say there's cost of goods sold and other expenses, just like there always was. But what we're going to do within cost of goods sold is we're going to break these expenses incurred to get inventory in a condition or location ready for sale into two groups. Firstly, the product costs, the ones that we can allocate to each individual unit on a logical basis. And then these period costs, the ones that we can't allocate to individual units on a logical basis. We'll still have other expenses, just like we always did. So what we're going to do now is go through each of these and plonk them in one of three bins, either the product cost bin, the period cost bin, or the other expenses bin. So the first one is easy. Whenever we get charged the price of the inventory, it's $180 per unit. That is clearly a product cost. So we say part of the product cost is the purchase price of $180. What about this delivery inwards? Clearly delivery inwards is a cost incurred to get inventory ready for sale. Can we logically allocate this $200 fee to each individual unit? And we can. It's $200 for 10 units. So really that is $20 per unit. So we can logically say that should go in here as a product cost called delivery inwards, $20 per unit. And now we can see the product cost is up to $200. What about this customs duty here? Well, clearly that is required to get inventory in a condition and location ready for sale. The problem here is I can't allocate it to each of these 10 units that I bought because this is an annual fee. I'll buy more couches later in the year, and maybe the fee covers other things besides couches. Maybe it covers bookcases as well. So based on the info I have, I can't logically allocate to this to each couch. I'm going to put it here as a period cost. Marketing of couches, $300, and it's paid with cash. So is marketing required to get inventory ready for sale? It's not. We don't need to market it to get it ready for sale. We incur that to actually sell it. So marketing would go over here as another expense, just like always. And lastly, when a customer does buy one of these couches, it's going to cost us $500 for a total of delivering 10 couches. So, is that required to get, well, first of all, can that be logically allocated to each unit? It can. Looks like we're going to incur a fee of $500 for 10 units. That's $50 per unit. So we could plonk it here in the product costs, but we're not. We're going to put it over here as another expense. And that's because the delivery cost to the customer is not required to get the inventory ready for sale. So we can allocate it logically here, but because it's not required to get it ready for sale, it doesn't matter that we can allocate it to each unit. We pop it over here in other expenses. So what does all that mean? It means now the cost. So if we just go back a step here, you might look at this and go, well, what's the cost of each couch? And you go, it's $180 because that's what the supplier charged me. It's actually not. What we say now is the cost of each couch is $200 per unit. And that's going to be really important because now we just want to say the cost of each couch or each unit of whatever inventory, the cost of inventory is what we call product cost. Okay? So the cost of inventory is its product cost. How is that going to affect everything we do? Well, let's start with the inventory card. That's the first thing we do with inventory. We put it in an inventory card. So what we've got is the product costs here in green. That went in there. The period cost here went in there. And the other expenses went over here. So in the inventory card, what is the inventory? Is it the purchase price? Yes. Is it the delivery inwards? Yes. These are actually part of the inventory now. Is customs duty part of the inventory? No. So we're not going to put the customs duty as part of the inventory. So what would we do here? There's a couple of ways to do this. I'm going to use the method I use first, and then we use another method, and you just use whichever one you prefer. Let's take this one. The first one was $180 per unit on invoice 345. So I go here and I say on January the 1st, on invoice 345, 10 units came in at $180 each. That's a total of $1,800. However, the couch or the inventory is actually, the cost of it's a little bit more than that because I allocated this delivery inwards here as a product cost here of $20 per unit. So what I've got to do is say with check 89, so that was the document here, 10 units came in at 20 for a total of 200. And what it looks like here is that 20 couches came in. They didn't. What we're saying is 10 couches came in over here. And in the balance column, we'll put 10 for 200 is 2,000. What we're saying is those couches are kind of made up of two things. There was the purchase price of $180, and then we added to those 10 units another $20 for that delivery inwards. Now, another way you can do that, some people prefer to do it this way, is just to put it all on one line and just do a double reference with the details. Just do invoice 345/check 89 and just do 10 at all $200 for 2,000, and then you plonk that in balance. Either way is fine. I like to do this one because it shows all the different product costs. It shows that the cost of these couches is actually two things, purchase price and delivery inwards, but it doesn't matter. But the rule number one with product costs is they are recorded in the inventory card, whereas with period costs, they are not recorded in the inventory card. So that's really important. You can see the customs duty here was not allocated to each unit, so it would never appear in that inventory card. The next thing we got to do is the general journal and the inventory ledger. So here's our info just from before, and we said this one's a product cost, supplies price, delivery inwards was a product cost, customs duty was a period cost, and marketing and delivery to customers are other expenses. So if we were going to do the general journal here, let's just start. We're going to do it document by document. Each document would be a separate entry. What we'll do for the sake of simplicity is we'll just combine these last three here in a second. But let's take this one. Suppliers price, 10 units at 180, invoice 345. So we're going to do the date. We'll say inventory was 1,800. That's 10 units times 180. We would have got charged some GST. And the credit will go to accounts payable. That is an entry we've been doing for a long time. So over here in our ledger, we'll have inventory, we'll do the date, we'll do 1800 and we'll do our reference. We'll say, where's the credit that matches up with this? It's over here in an account called accounts payable. All right, let's do this delivery inwards. And this is the one that's new. This is the one where we could make a mistake. Now I'm actually going to do the mistake. So the first thing we're going to do is January 1st, we're going to have an expense called delivery inwards. And we're going to debit it $200 because it says there, delivery inwards. We'll have some GST. And this one is a check, so we paid it with cash. And then we go over here, we make a delivery inwards ledger, we plonk it in there, and we do our reference as cash. And that is actually wrong. Because this is now a product cost, there's actually no such thing as delivery inwards. Delivery inwards is not an expense because we allocated delivery inwards to the inventory. So what we actually do with all the product costs is we say no. So just go back, we change delivery inwards, we change it and say no, it's part of the inventory. So there is no delivery inwards ledger, that's gone. What we should do is put that in inventory there. So the total of the inventory is $1,800 for the purchase price and $200 for the delivery inwards. So, rule number 2, product costs do go in the inventory ledger. They do not have their own ledger as they don't exist anymore. So there is no delivery inwards expense anymore, okay? It's attached itself to the value of the inventory. Now with the period costs here, we would just make it its own ledger. So we actually would just do what we've always done and say there's a ledger called customs duty and we plonk that in there. Same with marketing. And our second part of our rule, period costs do go in their own ledger. They are not a part of the inventory ledger, just like every other account we've always done before. Marketing and delivery will just be expenses as per usual, and just for the sake of time, I'm just going to combine all this into one entry here. We probably should do it separately though, because there are different documents. We'll just say marketing is an expense. That will go there. Delivery outwards, I guess we'd call that, or delivery to customers, that's an expense, so that would go over here as a debit. Have some GST and some cash. But the main thing here is we learned product costs do go in the inventory ledger here. We can say 1800 and 200. Period costs do not go in the inventory ledger. They have their own ledger, like here in customs duty. So, another rule is whatever is in the inventory card, so the total here, in this case, depending on which method you use, either one of these is the same, but the value is 10 units at 200 for 2,000. The total of that inventory card must match the total in the inventory ledger. So we can see here, let's take the way I did it. We did 10 at 180 for 1,800 and 10 at 20 for 200, which became a total of 2,000. That should match the value in the inventory ledger, and we can see it does. We've got the 1,800 there and the 200 there. So that's really important, that rule. What else should we do? Well, we've got to, let's say we did an income statement for this. What would it look like? So first of all, let's say during January, we sold all the 10, so we bought 10 couches, and now we sold them all, and each one has a selling price of 500. So we're not really up to income statements yet until the next chapter. We just need to know the basics. But the first heading would be revenues, and we will put for sales 10 units at $500. That's a total of 5,000. Now, sometimes we should have sales returns. We're not going to have sales returns here, just to make the example a bit simpler. So we'll go to the next section, which would be a heading called cost of goods sold. What we should do now, and what we've learned, is that cost of goods sold is two things. It is product costs and period costs. So the first one is these two here are product costs. What does that mean? We said this is the value of the inventory here. And what we said is that worked out at $200 per unit. By the time it was $180 per unit purchase price. And then we allocated $20 per unit for delivery inwards. So the cost of each sale here was actually $200 per unit. So 10 times 200 is 2,000. And what we can see here is an entry we've been doing for a while. If I said to you we made a sale of $2,000 of inventory, what would you do to this ledger? You do a credit there called cost of sales. That's actually what we're going to put up here in the income statement. So the cost of sale is the cost or the product cost of the inventory that we sold. What does that mean for this customs duty? Where does that go? It was its own ledger, so we said it does have its own ledger here of $200. But remember, a product cost is still cost of goods sold. It would go up here, however it goes in as itself, if that makes sense. It doesn't attach itself to the value of the inventory, so it's not cost of sales. It would go in here as customs duty. And what we do is we then say, rule number 4 is the cost of goods sold section will include the product costs, and they get reported as cost of sales. And then the period costs will go in there, and I'm not sure how to word this, but I guess one way to remember it is that they get reported as themselves. So if it's a period cost called customs duty, or buying expenses, or freight inwards or modification costs, whatever it is, it goes in the income statement as itself because it's got its own ledger. We would have a gross profit, and then what we should do is take away our other expenses. What would they be? Well, we said that's going to be the marketing and the delivery, so they've got their own ledgers. So they would go in there, just like they always would, and then we total that up and we would get a final net profit of $3,000. So the main thing here is, in fact, I think some of those numbers are wrong. That's not what's important right now. What's important is where you put each expense. The product cost, it says here, the rule says, gets reported in cost of goods sold as cost of sales there. The period cost get reported as themselves in cost of goods sold. And then we've got other expenses, just go in the other expenses section as they always did. What else do we need to know? We could just summarize this in one table. This has been a long video, so we want to make sure, we pause it as we go and we reflect on it. But if we could summarize this all in one go, we could say product costs, expenses incurred to bring inventory, condition, and location ready for sale, and so are period costs. And they're both a part of cost of goods sold. How are they different? Product costs can be allocated to each individual unit logically. Period costs can't be. We also said the product cost is now what we call the cost of the inventory. Other expenses is our third category. So we've got cost of goods sold with product costs and period costs, and then other expenses was still other expenses. What about this? Do they go on the inventory card? Yes, product costs do. They are recorded in the inventory card, but period costs are not recorded in the inventory card. What else did we learn? Which ledger do they go in? Product costs go in the inventory ledger. They do not have their own ledger as they don't exist. They attach themselves to the inventory. And the total that goes in that ledger must match the total of the inventory card. What about with a period costs? They still keep their own ledger. They are not a part of the inventory ledger. And finally, how are they reported in the income statement? Well, we can see here they're both within something called the cost of goods sold section. So product costs are going to go in the cost of goods sold section, and they'll get reported as what we've been calling cost of sales. Whereas a period cost would go in the cost of goods sold section, but it would go in as itself. So if it's called buying expenses, it shows up as buying expenses. If it's called customs duty, it goes in as customs duty. So that's a long video. So we want to pause that, take our notes, go back and watch the example again, just to work our way through it. So all we need to do now is just deal with some, it seems quite straightforward with that example we just did, but what about when there's some particular costs that really you're not sure whether it's a product cost or a period cost? Well, we better deal with that in the next video.